record,
Dr.
Dr.
Ted
Ted
Luong is representing Dr. Mitchell
Latt.
Mitchell Katz in the voting capacity. I'd like to propose a motion to adopt the minutes of the audit committee meeting held on July 16, 2025. Do I have a second?
Second.
All in favor, say yes.
Yes.
Motion's
Motion's
adopted.
adopted.
Uh-oh, I'm
I'm
supposed to poll each member.
I
I
always do
wrong.
this one.
Okay, we'll do the
We'll
next
do the
one.
next one.
We are now
We are now gonna,
I need a motion to convene into executive session to discuss confidential and privileged matters that may be related to threatened or potential litigation. Second, all in favor, say yes. And we are now going to retreat into the small room.
Let's go. Let's see.
No, just start. Everyone, next on the agenda will be the presentation of the KPMG fiscal year 2025 report by Maria Tiso.
So, good morning, everybody. I just wanted to introduce my team. So over to my right is Camille Fremont. She's one of the partners. Ryan Santanacita, he's a managing director, and Yamiao Chen is a senior manager. So that's part of our team. And today we're going to be going through our required communications as it relates to the June 30th, 2025 audit. I just wanted to start off saying that the audit went very well. As you know, this is the second year that we're been engaged to be the auditors. I wanted to especially thank Dave and James and Joseph for all of the help that they gave us throughout the audit. And what's really important is that, they'll call us throughout the year, to bounce things off of us, which actually is good so we don't have any last minute surprises. So I'm thankful for them for helping us get to this point. On Friday, which will be October 17th, we'll be issuing an unqualified audit opinion in accordance with government auditing standards, and that's the highest level of assurance that the financial statements are free of material misstatements. There were no unusual transactions that occurred during the year. However, you'll see a subsequent event disclosure. There was a bond financing that occurred in August for $243 million, so that's been disclosed in there. So we worked with management and the banking institutions through that financing. There were also no corrected or uncorrected audit misstatements, so the information that management has been provided to the committee didn't have any adjustments from the audit perspective. And again, we had no disagreements with management or any significant deficiencies. Like I said, year two went very smooth. So what I wanted to do now was turn to the deliverables page, which is page 2. These are the deliverables that we'll be issuing this year. They're consistent to what we issued in the previous years. There's the audit report that we'll be issuing on Friday, and it'll also include a report on internal controls over financial reporting and on compliance. And then we'll be issuing a debt compliance letter in connection with the outstanding bond. So those are all similar. And then we also listed here what our future deliverables will be. We'll be coming back to this committee in December to go through the management letter comments. We're working with management on those currently. And then we'll also be working on the HHC ACO and Metro Plus. Those are December 31st, 2025 year ends, as well as the HHC insurance company. So those will be issued sometime in mid 2026. And then we also, throughout the year, work on the various RHCF4, there's various regulatory cost reports that we work throughout the year on those. Okay. And then on page 3, I'm not sure if we went through this slide last year, but obviously our number one goal is to make sure that we provide exceptional client experience to the organization. And what we want to make sure that we do is the people that are staffed on our engagement have specific healthcare and government industry experience, and so they can work with management to make sure that we're identifying anything unusual that needs to be addressed throughout the audit, but also making sure that our team uses the latest technology, right, to make sure that the audit is more efficient and effective. So each year we keep adding new technology as new technology comes into play. And I'm going to turn it over to Ryan. There was a new technology that we use called transaction scoring, which is on the next slide that he'll just give a high overview of.
Thanks, Maria. And yes, as Maria had mentioned, we implemented the transaction scoring process over the OTPS financial statement line item. This scoring is really focused on vendor-based invoicing. And I'll kind of just give a brief overview of what transaction scoring really is. So transaction scoring is a robust data analysis that surpasses historical sampling methods. It analyzes 100% of transactions and subledger populations, which will allow us to conclude on in-scope accounts. Through that analysis, it runs each transaction through approximately 11 control points, and it provides a score for each of those individual transactions based upon the control point hits. If a transaction, and it will bucket them into low, medium, and high. If transactions are identified for further consideration, it's more than just a pass-fail type test. So if a transaction has 3 control points that it fails, it may bucket it into the medium, or depending upon how it scores, it may put it into the high. So again, as I mentioned, each transaction is scored low, medium, and high, and the statistical and advanced data analysis provides sufficient audit evidence for any transaction that is scored as low. So those are considered tested, and now again, we're taking 100% of that transactional level detail and running it through this tool. Then we will review the high and medium buckets and determine if we need to do further investigation. So for this year, we had some high and medium bucket identified, and we ended up running a sample over those. So and we tested a sample of 8. Really, the crux of the transaction scoring is really to look for more exception-based matters. So versus just doing a random statistical sample and looking to conclude, or in some instances having to continue to expand and expand and expand. So it allows for improved audit quality, and also does allow, can provide insights to management, as usually if there's a certain type of transaction that's occurring, it doesn't necessarily mean it could be an error, but we can work with management to understand why this transaction continues to occur. So overall, again, as I mentioned, we utilize it over the OTPS line item, which represents approximately $3.7 billion of activity for the corporation for the year. So those are really I'm not going to get into the details of the exact slide, but that's kind of the overview of transaction scoring. And again, we implemented it in the current year.
And you use this for Metro Plus and the other subsidiaries as well?
So Metro Plus is a different test, because the way that the corporation works is you have the HHC column and Metro Plus. The insurance side, it does not work on the insurance component of it. So claims payable is actually tested under a statistical sample, but the focus for when we were evaluating it, we noted that OTPS in the HHC column, which is primarily vendor-based invoicing, could be utilized there.
Okay.
And we'll talk a little bit more about the Metro Plus claims testing
Sure.
in a bit with that sample. But really, it just gives for a better audit,
Sure.
conclusions in the area, especially where OTPS is the largest account balance on expenses. So there were no major findings, which was a good thing using this tool.
Right, so you didn't find that having much more granularity using transaction scoring uncovered more discrepancies or high-risk kind of transactions? Is that?
No, when they're bucketed, we look to disaggregate the accounts based on different. So like if there's a repairs and maintenance or a temp services line, we will understand majority of the transactions are scored within the low bucket, again, depending upon the output. But we didn't find any anomalies. Yes, there might be certain transactions that will reach certain criteria, but upon further review and investigation, those transactions were not identified as errors, but rather just they had met certain statistical criteria.
Mm-hmm.
Seems like they were more routine in nature. Right.
But it's great to have that.
It allows you to visualize where the expenses are falling, and then we can ask more detailed questions about items we would not have known about in the past when you're just doing a pure statistical sample. So it allows us to really embed risk assessment into our testing as well and focus on those areas that.
Because you could be lucky one year and the sample you have could have no errors, right? Just based on the sample. Right, but this kind of hones in on like the high risk areas that you should be looking at. So again, technology is every year there's something new, and we try to make sure that we're incorporating it to make sure that we're providing value add to the organization. And it's not just finding things, but providing recommendations for management how to improve the certain areas too. Okay, Ryan, do you want to go?
I'll continue on to required communications.
I think I went through most of them.
Yes. So yeah, as Maria mentioned, she did cover a number of required communications. So I'll try and keep this on the higher level, but I'll cover next steps on slide 10. There were no corrected or uncorrected audit misstatements. Oh, sorry, if you could just go back one more, please. Sorry, one more.
Yeah.
Yep. There are no corrected or uncorrected audit misstatements. At the time of the mailing, which was 10/9, we were finalizing the claims expense test work, and we were at this point in time, we have completed and concluded that there are no uncorrected misstatements identified. I'll cover changes to our plan risk assessment on slide 9. Maria covered the auditor's report and the opinion already. Email will discuss some of the significant accounting estimates. And then to the best of our knowledge, we're not aware of any management's consultation with other accountants, and there were no disagreements with management. Moving on to the next slide. Significant accounting policies are disclosed in Note 1. There were 2 new GASBs adopted in the current year, neither of which had a material impact to the financial statements. Those are disclosed in Note 1T. Maria did already cover subsequent events, and we do know we had one consultation with our Department of Professional Practice to close out a prior year legal matter. There was no suspected or actual fraud involving management, employees, or employees with significant roles in internal control. Our written communications are the engagement letter, the management letter, and the management representation letter. Lastly, with respect to independence, we're not aware of any relationships between KPMG and New York City Health and Hospitals that may reasonably thought to bear on our independence. We will cover some inquiries of management and the board on page 15. Moving on to the next slide. This is we just wanted to explain we had a change to our since our audit plan. We had to change our plan audit strategy. As a response to the unfavorable change in estimate specifically related to the Dish Max receivable, the engagement team revised our risk level involved in auditing the receivable from a base risk to an elevated risk. The third-party estimate was identified as an accounting estimate in our audit plan, and this is just making the committee aware of the change related to the assessed risk. Additionally, our engagement team engaged a subcontractor, Health Management Solutions, which has specific knowledge in third-party reimbursements, specifically New York State, to assist in the review of the current year estimate, the underlying methodology, and the assumptions. Next steps, again, this was prepared as of October 9th. We continue to finalize and review the financial statements, which includes the partner and our concurring review partner. We actually received the final tax review this morning. And then we continue to, we finalize the test work in the areas of claims expense, which I'm going to turn it over to Camille very briefly, very shortly to explain some of the claims expense. The debt compliance test work has been completed, as well as the statement of cash flows. We're going to continue to follow up on any remaining PBC items from the client and finalize our documentation. Again, and then we'll evaluate subsequent events through issuance, which is expected to be Friday, and we'll inspect any available minutes and obtain the signed management representation letter. I'm going to turn it over to Camille to talk briefly on the claims expense test work.
Sure. So as a reminder to the committee, Metro Plus gets the chance to be audited twice, if you will. They're audited through 6/30/25 for purposes of the corporation's audit, and then they have a standalone audit for 12/31 as well. So first and foremost, would like to thank the management of Metro Plus for all of the help they've given us as we're progressing through the audit for 6/30 and also doing work that we can leverage for the 12/31 audit as well. During our test work over claims expense, we looked at the claims paid and we focused on the period of January 1st of 2025 through June 30th of 2025 at this point, because we leveraged work from last year's 12/31 for the period that crosses over into the corporation's year end. In that sample, we did find some discrepancies in the amounts of claims that were paid. It was caused by various factors like incorrect contract configuration, as well as some manual claims intervention. We're continuing to work with management to identify additional claims that we need to test for purposes of the 12/31/25 audit. But I do want to also acknowledge that there are high-level monitoring procedures in place at Metro Plus, including a review of weekly check runs to discover any potential anomalies if there was a claims processing issue, as well as high-dollar claims reviews. The totality of what goes on throughout the claims process allows us to conclude that these errors that we found in our samples are a significant deficiency, but it does not rise to the level of a material weakness for purposes of the 630 audit. We will, as Maria mentioned, come back in December to present the management letter comment and continue to work with management as we step through that process. And then again, we'll continue to test claims for the standalone Metro Plus 1231 audit. I'll pause there in case there's any questions.
I guess when Metro Plus gave us a brief presentation on the issues, it was surprising, like one of them involved a $50 error. But I guess your, I'll call it extrapolation system, resulted in having that appear at least less insignificant than it does.
Correct.
Correct.
Right.
So that's why we're continuing to test the claims for purposes of the 1231 audit, nor would we suggest that management should book to our extrapolated
Exactly,
number.
right.
We just need to continue our testing for this time period plus the second half of the year to allow us to conclude on a standalone basis for Metro Plus for that audit.
Yeah, because in that where it says the $50, there'd be no way for us to be able to go in and test every single claim, right? It would be an enormous task for
Right.
both management and for us. So in that particular instance, in order for us to conclude that it's not a material weakness, right, we need to kind of put a box around it, and the way to do that is to extrapolate it over the population so that we can have kind of a guidance of, where this control finding would fall into. And really a significant deficiency is just making sure that, management and the audit committee is aware of it, right? But it does not rise to a material weakness.
Right.
Okay.
Are there any other questions? Okay.
The accounting estimates and our procedures and conclusions in those areas.
So we can go move the slide back, like the 4 slides back. Yes, so the first accounting estimate we look at is evaluation.
Turn on.
So the first accounting estimate we look at is the valuation of patient accounts receivable. We perform an independent look-back analysis on the June 30, 2024 patient accounts receivable using the actual cash collected. And then with the cash collection trend we saw on the June 30, 2024 AR collection, we developed an independent estimate using our data analytic tool for the June 30, 2025 AR valuation. Based on the test work we performed, we did not note any indication of management bias, and we concluded that the valuation of patient accounts receivable for June 30, 2024 is reasonable. Turning on to the next page. The next accounting estimate we look at is the valuation of pension and OPEB obligations. We utilized a KPMG actuarial specialist to look at the actuarial method and assumptions such as discount rate, expected rate of return on assets, as well as the mortality table, which are the assumptions used in developing the estimate. And then we compare that to the respective framework of GASB 868 and 75 to making sure they are consistent to the accounting framework. In addition to that, we also perform detailed test work over the relevant data estimate, the elements that's maintained by management and supplied to NYSER as part of this valuation for those two obligations. We also reviewed the financial accounting disclosures to making sure all the required disclosures are included in the financial statement. Based on the test work we performed, we conclude the valuation of those two obligations are reasonable. So turning on to the next page, the next accounting estimate is the third-party receivable related to the Dish Max program, which is the same receivable that Ryan talked about, that we elevated the risk from base risk to the elevated risk. The reason is because there's a change in management's calculation about how they calculate the dish max receivable. In response to that, we engaged our subcontractor, which is Healthcare Management Solutions, with a specialist with like knowledge experience, especially with the reimbursement of New York State, to help us look at management's revised methodology and assumptions. And we also tested the data used by management in their revised methodology to come up with this estimate. And based on the test work we performed, we conclude that this estimate is reasonable as well.
Question on that. So the risk was elevated because management changed the methodology? Is that the reason for the risk elevation, or did something else change?
So management had recorded, I believe, in either the end of first quarter or end of second quarter. These estimates are on a lag. So the 2021 DISH audit was completed by the state of New York, which resulted it was about a $700 million negative change in estimate. So it was a hit to net patient service revenue. And as a result of that, future years that were still open, that were subject to DISH audits, the methodology needed to be revised to ensure that the results of the DISH audit were flown through the previous years based upon the most recently available information. So with that change occurred, that's why we had, had in previous years, there were no matters as such. So with that, the change in methodology, as well as essentially the settlement of the 2021 DISH audit, resulted in, KPMG taking a step back and saying, okay, maybe we really should be revising this to ensure that the methodology is appropriate based upon the latest available, audit results and reflects it through.
So the audit results gave clarity as to what our receivable should be. Is that, am I understanding that?
We just, what our procedures did was just conclude what management had done from an audit perspective.
I'll speak to this a little more if you don't mind. So we had a methodology that Ryan described well that has this flow through component. For year end, we actually modified that methodology to make it more bottom up, so that it's more reactive to changes, because we felt that methodology built on a lag was not as good as detecting changes. We keep evolving as an entity in real time, our business model change. So we want to make sure that we have this bottom up approach. So this year at year end, we actually modified the methodology. It's still, I wouldn't characterize it still yet like purely bottom up. It's still like a hybrid. But there are components of it that are more bottom up than they were before. So I believe, Kate, you guys looked at that.
Exactly. We just felt that we needed to, dig deeper into the methodology to make sure that we were okay with the assumptions and the changes that management had made for that calculation.
And to further David's point, from 21 forward, the state of New York has also changed some of the way that they've done reimbursement methodologies, specifically with UPL add-ons, conversion rates, which previously 21 and prior, those really weren't a factor in determining the methodology, because they weren't in play in terms of a reimbursement method for the corporation and within the state of New York.
Okay, so I guess the elevated risk is just all of these things changing enhanced the focus of
Correct.
KPMG, and then KPMG, based on your review of the estimates, dug into what management had done and conclude that it is a fair and reasonable.
Exactly, because if you remember back in June when we came to go through the audit plan, right, a lot of these changes weren't made yet, so we wouldn't have known.
Right.
That's why we had kept it at a base risk, right, because all these changes hadn't happened yet. But then as part of our audit procedures, we do monitor the changes that are made from the time we come here to the time we present our report, if things need to be changed, and then discuss it with the committee.
Good, thank you. Just one other question on the pension stuff. We had in the past some pension findings, and so this makes me feel like we're on much better.
Yes, there was no any corrected adjustments that needed to be made.
Perfect, thank you.
Thank you. So coming on to the next page, the last accounting estimate we look at is the valuation of incurred but not reported claims payable, specifically related to Metro Plus Health Plan. We utilize a KPMG actuary to perform an independent estimate based on the paid claims data, like historical paid claims data, to develop what we think the IBNR should be for 6/30/2025. And then we also perform a look back analysis of the IBNR reserve for both 12/31/24 and 6/30/24. And then we also perform test work over the paid claims data as well as the membership data, which are the two data used in our independent analysis. Based on the procedures performed, we concluded that there's no indication of management bias, and management's valuation of the IBNR claims payable is reasonable as well.
Great. And then our last slide, you've seen this before, these are our required inquiries. So we have meetings with various members of the management team to determine if there's any non-compliance with laws, investigations, any fraud that we should be aware of, and nothing came to our attention. If there's anything that the committee, based on, after you reading this question, have something to, to discuss with me, please let me know. But these are just some of the sample questions that we go through with the management team, and nothing came to our attention. And then we also add an appendix, it's just a slide on the 2025 board agenda and our U.S. audit quality, transparency, and impact reports. That's just for the audit committee's review, leisurely review. If you have any questions, I know you guys are all very busy, but we just wanted to add it there. If you have any questions, definitely reach out to me. We can have a one-on-one discussion. Okay. But that concludes our presentation. If anybody has any questions.
I guess I just want to say, Maria, first, how proud I am of our folks that notwithstanding Clara and notwithstanding Dish, our numbers have come out very positively. So David and James, Talia and Lauren from Metro Plus, great work so far. And thank you and your team at this stage, because everything we've heard from our folks has been positive in terms of the kind of working relationship you have with them.
Great, thank you so much.
Okay. If we're done, then we're going to move on to David with the presentation of the FY 2025 draft financial statement.
Good morning. So today we will be presenting the fiscal year 25 draft financial statements for the Health and Hospital Corporation. Before we present the financial statements to the audit committee, I want to take the time out to thank key members of the controller's office team who worked tirelessly during this year and audit period to get the financial statements to the point they are in today. Some of them are actually here today. James Linhart, Joseph DeBroja, Nicole Fleming, who's our quarterback on the H&H side, Timmy and his team, they do a phenomenal job. I also want to thank KPMG, Maria, Camille, Ryan, Yim Yao for the wonderful partnership. I think every audit cycle just gets better and better, so thank you so much. So the financial statements are comprised of the statement of net position, aka the balance sheet, statement of revenues, expenses, and changes in net position, aka the income statement, and the statement of cash flows, and the notes to the financial statements. We'll focus on the consolidated income statement, which encapsulates the system's overall financial performance for fiscal year 25. So for fiscal year 25, the income statement is showing a total operating revenue on a consolidated basis of $15.75 billion and total operating expenses of $15.69 billion, which leads to an operating gain of $63.8 million. Factoring in capital contributions, there was an improvement in net position of $404.7 million and a positive ending net position of $95.7 million on the bottom line. Some key trends and drivers of H&H's financial performance. On the revenue side, I'll start with, we had revenue of $15.75 billion, which represents a decrease year over year of $105 million. Of that, net patient service revenue of $7.3 billion increased by $188.8 million. Note, this includes $239.6 million of UPL conversion revenue from prior year. Retro's revenue decreased by $554 million, mainly due to the change in estimates that we discussed earlier in this presentation. Offsetting the decline in retro revenue was an increase in inpatient revenue of $288.2 million, outpatient revenue of $307.7 million, and an increase in SNF revenue of $37.9 million. Appropriations for the City of New York of $2.88 billion increased by $30.8 million year over year. The increase is due to unsubsidized tax levy and collective bargaining appropriations. Premium revenue of $5 billion increased by 199.6 million. Much of that due to favorable premium adjustments. Grants revenue of 406.5 million decreased by 510.5 million. Much of that relates to the conclusion of FEMA revenue recognition and impact of $136 million FEMA estimated disallowance. Other revenue of 163.8 million decreased by 13.6 million. Some of the reasons why we had a decrease of about 2 million in ACO revenue, 4 million in Health First Elmhurst dividend payment as compared to last year. On the expense side, we had expenses of 15.69 billion, which increased by 453.9 million. Starting with the components of that, PS expense of 4.5 billion increased by 610.8 million, mostly due to collective bargaining and increases in FTEs on the H&H payroll. OTPS of 6.97 billion decreased by 273.4 million due to reductions in HERC and temp OTPS spending. Fringe benefits of 1.25 billion increased by 57 million, most likely due to increases in FTEs. Pension of 299.6 million decreased by 141.7 million based on the New York City Actuaries report, mostly due to decrease in projected earnings on pension plan investments. Actually, it's the opposite. Increase in projected earnings. OPEB of 73.9 million decreased by 42.6 million due to change in discount rate from 4.21% to 5.2%. Affiliation expense of 1.95 billion increased by 237 million. Depreciation of 611 million increased by 6.2 million. As previously mentioned, there is an operating gain of 63.8 million and an improvement of 404.7 million to the corporation's net deficit position, which ended the year at a positive 95.7 million. I know I went through a lot. Are there questions related to the financials?
Okay. Thank you so much. David, did you have something?
No, no real questions, but thank you for the clear presentation of the impacts and the changes, and it's good to see things moving positively, particularly if we're getting more clarity on some of the different deferred revenue and things like that. So great work, and thank you to KPMG as well for your partnership. Great work, Dave.
I'm going to literally just ask Joseph and Catherine to give me 2 minutes each. Joseph, just on the two findings that we thought were top of the line for the controller's report.
Okay.
Oh, I forgot something. Wait 1 second. I would like to propose a motion to accept the fiscal year 2025 financial statements as presented. Do I hear a second?
Second.
All in favor, say yes.
Yes.
Okay, we're official now. So if you could do the top two findings in the state audit report.
Okay. The first audit is the audit of correctional health and the Department of Corrections. It's a joint audit.
Sorry, I'm not being clear. I'm going to incorporate by
language
reference.
access?
Yeah,
Okay.
I wasn't being clear. I'm going to incorporate by reference all parts of your report in compliance other than the ones that related to the audits. So the language access audit for you.
Okay, the language access audit. The language access audit, we received the draft report in August. We replied back in September 26th. We submitted a thing. We have not heard anything back from them since then on that. We should be getting a final report at some point. There were a couple different findings that came out in the report. One dealt with cost savings, which we responded to, and another was about audit needs assessment that was done, and we've also responded back in terms of those.
Thank you. And Catherine?
Sure, very quickly, just some activities that we've been working on. The documents basically speak for themselves on coal fire HIPAA risk analysis. We are doing some hot topics that we're pushing out to help educate people. It's one of the findings from our survey that people wanted more electronic communications about compliance and helping them to understand what their requirements are. We also are going to have Corporate Compliance and Ethics Week the first week of November, and that's a big thing that's nationwide, and we are going to have people, the compliance officers host tables where people can play games and win prizes. And then the only other thing is just some things that we've been doing. Deficit Reduction Act policy we had to do in September. You all received a copy of that. Statewide Common Participation Agreement is something that we are working with on. It's a state agreement that all providers have to sign. We have until December 31st. And Special Needs Plan Model of Care Training is something that is a Medicare managed care plan requirement of all special needs plan providers that participate in these plans, and they all have to do training, which we launched last week. Thank you.
Wonderful. Thank you both. Sorry to cut you short.
That's okay.
Is there any old business or new business to come before the committee? If not, I declare us adjourned.
This meeting is no longer being recorded.